Most retail traders lose money because they don't understand this one thing, liquidity. Because market doesn't move randomly. Banks and institutions need liquidity to exit and to enter the positions. And today I'm going to show you how liquidity works, how I use it in my trading strategy, and also how you can spot them on your own charts. So first we have to understand what liquidity is. Liquidity is areas where there are a lot of orders, stacked orders. It doesn't matter which one, as you can see here I wrote it. There can be stop losses, breakout entries, pending orders, it doesn't matter. As long as there are some orders, it is a liquidity pool. Liquidity can be on your charts in different locations and ways. So there are some examples. There are equal highs, there are equal lows, trend lines, session highs and lows, previous highs and lows, which is crucial. So let's look at it on live example. So basically we can take the equal highs. You can see here there, and also a big misconception that people have is that they search for a perfect equal highs, but actually in reality it's not how it works. It happens really very rarely. Those, I would say, there's really nice equal highs, relatively equal highs, and so there is some stacked liquidity. Equal lows, for example, here there are some relatively equal lows. Here is like more a trend line. Here is an example of a sell-side liquidity, so a relatively equal lows, which gets then liquidated, as you can see here, taken out, and then expansion to the other side. Trend line is also very big liquidity pool. Here all of that you see when price is constantly going lower, but slowly, so from like consolidation, as you can see here, it constantly respects this level, so tries to go lower, now goes higher, lower, higher, lower, higher, and then slowly, but it's going lower, and it creates a huge liquidity pool. So there are a lot of stacked stop losses, limit orders, pending orders, all over here, session highs, a lot of buy-side liquidity, which most probably in future will be taken. Then trend lines, yes, session highs and lows, really important. I use it all the time. For example, I trade London and New York session. I like really when London sweeps either one side of Asia, for example, Asian high. If I want to go short, lower, then I like it really nice. So here you can see this, so the blue is Asia session, it gets liquidated, and then London goes in then different direction. Then New York comes out, liquidates London, goes in another direction, and you can see that a lot of the times it plays out. And if you can add this to your strategy and use it with your strategy, it is really powerful, I would say. So yes, and the biggest problem here is retail traders psychology. Most retail traders trade breakouts. Their entries and stop losses create liquidity pools. So that's why in my opinion, trend lines and pattern recognition strategies don't work. Because if a lot of people trade the same strategy, and so for example here, I don't know, head and shoulders, and a lot of people put their stop losses here, and they see a trend line like it's downtrend, bearish trend, they put their stop loss here, then what actually happens? Because the institutions need their stop losses and it will hunt them. For example, it's not in this situation, but I say it as an example. The institution take their positions to go lower, because I want you guys to understand liquidity on a much deeper level and not just some highs and lows on the chart. So basically what it actually means is that institutions and banks need liquidity to enter or to exit the trade, because they operate with really large amounts of money, hundreds, millions, billions of dollars. And for for them to place an order or to exit from order, they need opposing liquidity. So if they're buying some asset for $1 billion, they need somebody who sells to them for $1 billion. Because if, for example, here's a chart of some asset, it doesn't really matter, for example, of gold, and some institution wants to buy $1 billion of orders here, what happens? They put, for example, just $1 billion of orders, and then price pushes higher, collecting some sell orders, and then their whole position gets filled somewhere here. And instead, they don't want it because they want to buy gold here, but actually they bought here because there was no opposing sellers for them to buy, if it makes sense. So what they really oftentimes do, they push price lower, just fake out, push price lower. For example, here is some low, so low also represents a really big pool of liquidity, maybe some external low, just an example where are a lot of orders, and actually institutions can see your stop losses, so they hunt for them, and then they take this. For example, here was $1 billion of sell orders, and they buy here even at better price, and then price goes higher with them already, and they're not getting triggered on here, and they are willing to lose even few, like 20-30 million of dollars in order to get much better execution, if it makes sense. So yeah, it is a very powerful tool to understand. So let's go forward. Liquidity grab. Price moves into liquidity zone, stops, gets triggered, institutions enter position, price often reverses. This is exactly what I've told you right now. They induce prices, induce some orders, and then they push price in the opposite direction. That is what a liquidity grab means. Example scenario. For example, here on Euro USD chart, as you can see, we had some really aggressive uptrend, you see, and then some traders maybe seeing it as a really good opportunity to sell. Maybe we tapped to some higher time frame for value gaps, and they sold here, and this high became a very, very big pool of liquidity. And then long session goes lower. Long session goes lower. Then New York session just liquidates this high, and you can see that it is intentional because they liquidate, and then immediately price goes lower and lower because there was a lot of sell orders, basically. Yes. So yeah, I wrote here equal highs form, as you can see. Retail traders buy breakout, price spikes about highs, market reverses. Exactly here. Retail traders sell, liquidates, and then goes into another direction where they want price to go. Very simple. How smart traders use liquidity. Identify liquidity zones, wait for liquidity sweep, look for rejection, enter after confirmation. Now I will show you the live example of trade which I personally took on gold here. You can see it right here. As I told you that I oftentimes use sessions, low and highs, as a liquidity pool, and it also helps me a lot to understand the context of a trade. So for example, here we're on uptrend, I want to long, and what is my, so for example, yes, London opens here. What am I waiting for? I'm waiting for Asian low to get swept. And then also some like immediate small low also to get swept into the interest zone for value gap, and then I drop on lower time frame and search for just my entry confirmation. Doesn't really matter. The most important is Asian low sweep, in some internal low sweep into my point of interest, and then confirm the reaction and it plays out. Really simple. I use it on a daily basis, to be honest. And I really like this London sweep of Asia and then targeting the opposite direction. But also, don't please get me wrong, I not using only liquidity sweeps because I need context. For example, this trade had a really nice context on higher time frame from market structure perspective, not on liquidity. Liquidity is just one big part of a pie, which and a pie is my strategy. So yes, guys. Then common mistakes that a lot of traders make is chasing breakouts, ignoring liquidity zones, entering too early, obvious stop losses. So for instance, what I would do in my early stages of trading is I would see that, for example, I would mark out this high as my interest, what I want to see to be swept, and then price just doesn't come, it comes really closely, and then I see a aggressive reversal from this level, and then I want immediately to sell because I think that I am missing out on the move, that maybe on other brokers liquidation already happened and just on mine not, and it is a battle of your emotions and of your psychology. And I was exiting early, but now I understand that this was indeed my psychology problem, which I have already solved. And yes, much more likely, because here it is even worse to short from here because we have here equal highs. Perfect scenario would be to sweep those highs and to go lower, as an example. Entering too early and obvious stop losses, because if you see that you have like this this trend line, you see a lot of session lows, just basic lows, previous day's lows, Asian low, New York low, Asian low, New York low. This is an obvious drawn liquidity, and if you enter here, I'm not saying that it is 100% accurate, nothing is 100% accurate in trading. Usually you will get just stopped out because your stop loss is a target for institutions and banks. But what you want to do is you want to trade with them and not against them. You can spot them. For example, yes, on your USD chart, as I showed you, this liquidation was complete. It was intentional, and then you see an aggression comes into the market after this liquidation, after they have absorbed the opposing orders for them to go to reverse. You can trade with them. It is very it makes sense, I would say. So yes, guys, key takeaway from this video: liquidity drives the market movement. Retail traders create liquidity, as I already explained to you. Smart traders wait for liquidity sweeps, because liquidity is what actually drives the market. If you know how institutions are trading, just with pure logic that they need opposing liquidity for them to enter the position, then you can trade with them. You can wait for nice liquidity sweeps along with your context, with your strategy. It makes your trade even much better and much more accurate. And what I have noticed from my trading career, that it is crucial in trading. So yeah, guys, if you have some questions, something was not clear, please write us in the comments. I will, as soon as possible, write you back and help you with any questions you have. So yeah, guys, ciao. Thank you for watching.